Hey, Solopreneurs, Gabe here. Today is going to be a special episode. I'm going to talk about Roth conversions for solopreneurs and kind of walk you through what a Roth conversion is, why you would consider doing a Roth conversion, when you might want to consider doing those, and the how. And so, what I'm going to do is I'm just going to kind of share that information with you today and get rolling. So, here we go. So, what is a Roth conversion? Well, let me tell you what a Roth conversion is. Roth conversion is converting a traditional IRA type asset account, we could call it, to a Roth IRA account. Now, what you need to understand about traditional IRA accounts, that could be your SEP IRA, it could be a traditional IRA, it could be a Roth IRA, could even be your simple IRA that you might be using. You can convert those monies to a Roth IRA. And so what it is it's changing the tax structure and paying the taxes today of your traditional IRA and moving it into a Roth IRA. Now, I'm going to talk about why you would do that in a second. But let me just make sure that you understand a Roth conversion is converting from something that you got a tax deduction on, a traditional IRA, and changing it to something that would then be tax-free down the road. And so that's what a Roth conversion is. And for those of you that don't know what a Roth IRA is, that's listening to this right now, a Roth IRA is money that is put into a IRA, which has the Roth name to it, that is meant to be after-tax dollars. And if you've ever listened to any of my other episodes, I like to call Roth IRAs grocery money, the same money you use to buy groceries after taxes that shows up in your check or in your accounts after you pay yourselves. Same money you used to buy groceries you use to fund your Roth IRA. The beauty of a Roth IRA is the money grows tax deferred, which no taxes as it gets bigger. And when you go to take it out, as long as the Roth IRA has been in place for 5 years or longer, and you're over 59 and a half years of age, you will then reap the benefits of tax-free withdrawals. And that leads me into the why you would want to consider a Roth conversion. Well, if we know that the traditional IRA and our SEP IRA and our solo 401ks and our simple IRAs, we get a tax deduction when we fund them, then what basically happens with those types of assets is they grow tax deferred. And then when you go to take the money out, you are going to pay taxes at where your whatever your marginal tax rate is at that time. Easy for me to say. And so whatever the tax rates are is what you're going to pay for your taxes at that time. Well, what the Roth IRA does is says we'll pay the taxes now, and we're going to pay the taxes at the level that we know they are if we qualify to fund our Roth IRAs. And there's a really good chance that quite a few of you aren't eligible to fund your Roth IRAs because you make too much money. And the limits change every year. But I always tell people if you're making $200,000 a year or more and you're married filing jointly, there's a good chance you can't fund a traditional a Roth IRA because you make too much money. That being said, you can, because there are no income limitations on Roth conversions, you can convert traditional IRA money, like I've talked about, into a Roth. You'll just pay taxes at whatever rate you are. And so the idea behind the Roth IRA is you are paying taxes at the rate you know today, with the idea that the account is going to continue to grow tax deferred. And when you go to take that money out in retirement, you take it out and you pay no taxes whatsoever, which is an absolutely beautiful thing, is to be able to reap tax-free income during retirement. Now, why would we consider doing that now when we're making a ton of money, we're paying a lot of taxes, and we really don't want to pay any more taxes? Well, here's a couple reasons why, but I'm not telling you that you should. I'm just giving you some ideas and some thinking as to why you might want to do it. One is the lure of tax-free income in retirement. One of the beautiful things that I like to design into solo 401ks for my solopreneur clients is I like to design in traditional 401k and Roth 401k options inside of it so they can actually play the tax game on both sides of it and put in a chunk of money into traditional 401k, get a tax deduction, put another chunk of money into solo Roth 401k contributions because either A, they make too much money or they want to put a larger amount than they're eligible to under the current laws for your Roth IRA. But let's get back to the why. The tax-free income in retirement is the big why because we don't know what tax rates are going to be when we go to retire. Now, it's not hard to figure out that our government continues to spend money like crazy, which means someday down the road, our taxes are going to have to be higher so that we can actually pay all the bills that the government has. And if we believe that, then the lure of having tax-free income in retirement starts to get pretty darn nice. And what I like to use is call it kind of a bucket strategy where you're going to have some taxable money down the road, meaning your IRA money or your solo 401k money, or even if you created a cash balance plan or defined benefit plan to get big tax deductions, you're probably going to have some taxable money in retirement. But if you can offset that with some money that you're going to go to live on during retirement with tax-free, that completely changes your tax structure when you go to retire because now you are able to use tax-free money, offset it with taxable money, and maybe cut your tax bracket in half, which means you're starting to win the tax game. So let's just use the simple example. If over the course of time, you're able to build up a bunch of Roth IRA money or Roth 401k money, and you go to retire and you start to pull money out, and while today you're working, you're paying in at a 30% tax bracket for simple math, and you go to retire and you're able to utilize traditional 401k money or IRA money and offset the income you need with Roth money, you then have 0% tax on one. And let's just say for fun and games, 15% tax on the other because you're not taking as much income out. Or even if you were, you're able to utilize the 0% tax bracket on one, maybe 15% tax bracket on the other. You've now just won the tax game, meaning you deferred when you were making a bunch of money and got a tax deduction at 30%. And then you turn around and you come back and retire and you pay taxes at 15%, which means you're 15% of the game, 15% ahead of the game. So that's one reason you want to consider having Roth conversions in your wheelhouse. The other reason, and I just talked about a little bit ago, is tax rates. We don't know what tax rates are going to be when we go to retire. I just turned 50 here in December of 2021. I don't know what tax rates are going to be when I get into my 60s or even 70s when I decide to quit working and start taking money. And so it allows us to start to then plan to have some 0% tax rates down the road. And then the other piece of the puzzle is it allows you to pay the devil you know now for what you don't know in the future. Meaning you pay the taxes today and you know what they're going to be. You know you're at a 30% tax bracket, so you know you can pay that and it's there. And for offsetting the idea that the account is going to grow, it's going to get bigger, and then all of that money is going to come out in retirement at a 0% rate. And so that's the beauty. One more reason that I see a lot of these Roth conversions happen with my clients is I have quite a few retiree clients that frankly, they don't need all the money they have. They're living a very comfortable life. They don't need all of the retirement assets that they have. And they're kind of worried about what's going to happen to these funds when they die and they pass down to the next generation. And so, what a lot of my clients are doing that are retirees is we're starting to look at Roth conversions to allow for the assets to pass down to the next generation tax free. So, let me give you a little bit of a 101 on this. When you have an IRA, a 401k, a SEP IRA, a simple, all of that tax qualified pre-tax investment accounts, which are fantastic, and you pass away, there are beneficiaries on the account. And those beneficiaries are the people who are going to inherit your assets at the time of your death. Now, it might be your spouse, but if your spouse predeceases you and it goes down to your kids will inherit that money. It's not a taxable event when they get it because it's going to go into what's called a beneficiary IRA, unless your kids decide to just go spend it, cash it all out and pay the taxes and the penalties at that time, which does happen. But the Secure Act that came about during the pandemic came out and basically requires non-spousal beneficiaries, plus a few other exceptions, to liquidate their inherited IRA accounts within 10 years, which means the IRS says, okay, you passed away, your money goes down to your kids in these IRA accounts that have never had taxes paid. And the IRS says, okay, that's great, but you need to take that money over the course of the next 10 years. All right. Well, depending upon how successful your kids are, that could be a healthy tax bill, or it might not be that big of a tax bill. Now, the IRS says we'll waive the 10% penalty for taking it before 59 and a half if your kids are underneath 59 and a half when they inherit your money. But they're required to take it out let me rephrase that. They're required to liquidate it over the course of 10 years. It can be once a year, it can be every other year, it can be one lump sum, it can be however they want to do it, but they will pay taxes on it at that time. Well, a lot of my clients, like I just said, will start converting IRAs to Roth IRAs so that they know that when the kids inherit those Roth IRAs, it's a tax-free transfer of wealth. The IRS requires, under current law, for them to liquidate the account over the course of 10 years. But there's no taxes due on it, which is an absolutely beautiful thing. So those are the reasonings as the why you would consider a Roth conversion today, or even when you start to get close to retirement. Tax-free income during retirement, which is a fantastic idea. Tax-free inheritance for your kids. And then the last one is to pay the devil that you know now versus the devil that you don't know, with the prospect that we could have higher tax rates when we go to retire. So I've talked about what a Roth conversion is. I've talked about why you would want to consider it. And now I want to talk about when you might want to consider it. And when, like I just said in the last example, as to the why is when you realize that you have too much money for retirement, which sounds kind of weird, but it actually does happen quite a bit where you're not going to run out of money. So if you start to realize that, then you might want to consider start doing some Roth conversions. So that's one reason when you start to realize that, so that you want to start to transfer the wealth that you've created down to your heirs on a tax-free basis is one. Another one is when the market is down. When the market is down 10, 20, 30%, it's a fantastic time to start looking at Roth conversions, because we all know the market is going to be volatile. It's going to go up, it's going to go down, it's going to do what it's going to do. Over the course of time, we've also learned that it continues to go up. So taking advantage of big dips in the stock market is a fantastic time to convert Roth IRAs, because you convert a larger chunk of assets. Yes, you will pay taxes on that when that conversion happens in that taxable year, which I'll talk about in a little bit, but it allows you to convert it at a lower amount of the value of the account. Then when the market rebounds, you basically just, for lack of any other way to put it, you kind of just supercharged your Roth IRA. You took advantage of a stock market drop, you turn around, you reinvest the funds and let it bounce back up with the market over time. Not a bad idea. You pay less taxes and you get an opportunity for that Roth IRA to get a jump and move up a little quicker. Now, the other thing that you're going to consider the win is if you have room in your tax brackets. Now, what I do is I have a tax report that I run for my clients. I get a hold of the tax return, we put it in the software, and it shows me where your income is sitting so that I'll know how much room you have in your tax brackets before we tickle up into the next tax bracket. So you might be sitting at a 22% tax bracket and have $20,000 of room that we could do a Roth conversion and still keep you in the same tax bracket. The good of that is then we start to understand how much you really truly could convert, and then what we think it might cost you in the form of taxes. Because when you convert a IRA to a Roth IRA, you're going to pay taxes on that amount at your marginal tax bracket. And so the simple math of my example, if you're in a 22% tax bracket and you had $20,000 of room, then we know that 22% of $20,000 is $4,400. You could start to budget for that throughout the year and plan that you're going to pay those taxes come April of the following year. Now, the other thing you might want to consider doing is when your income is down. If you're having a bad year, which solopreneurs, we have bad years sometimes. It's not always fantastic where our income just keeps going up every single year. Sometimes we have a down year. And if we have a down year or we have a major loss in a business or whatever it might be, that's a fantastic time to consider converting some of your IRA assets over to Roth IRA assets. And depending on how bad of a year it is, you might even get the ability to have that be a tax-free conversion because your income is so impacted by whatever might have happened. Just another win to consider, another idea of win. So you're going to do it when the market is down. You're going to do it when you've got room in your tax brackets. And you're also going to consider it when your income is down or you had a bad year. Those are some ideas as to when I talk to my clients about when we might want to consider doing those. So we've talked about what a Roth is, conversion. Let me rephrase that. We talked about what a Roth conversion is. We talked about why you would want to do it. We talked about when you would want to do it. Now comes the how. Like, how the heck do I do this Roth conversion thing? Well, the simple answer is it's the piece of cake. It's just a paperwork exercise. Now, I'm simplifying it because I like to sit down and go through, all right, let me see what the tax return looks like. Let me see what the tax report looks like. Let me see how much room you have and what is the impact of it going to be. And then we do the paperwork exercise. You're going to choose the amount you're going to convert from your IRA, simple IRA, SEP IRA, etc. And you're going to then complete the paperwork with your custodian and submit the paperwork. And then they will move those assets over, whether it's cash or the securities in kind, into your Roth IRA. That then triggers a distribution from your IRA to your Roth IRA. A 1099 gets generated, and then that comes to you usually the first couple of months of the year following. And so if you did one in 2022, a Roth conversion, you're going to then get your 1099 in basically early of 2023, and you'll then file that with your taxes in April of 2023 as an example. So the how is easy. It's really just a paperwork exercise. The why and the when is the big, I guess, to pull something from The Office, that's the big tuna. That's the, all right, here's why I'm going to do this. And here's then when I'm going to do this. And then the how is really just a paperwork exercise. So the big result is this. You're going to pay taxes now versus later. And depending upon your situation, you're either going to have the opportunity to pass assets down to your next generation tax-free, or you're going to basically set yourself up to be in a much lower tax bracket when you go to start taking that money out during retirement. And so what I would say is take a look and see what's going on in your situation and reach out to your advisor. If you don't have one, reach out to me. I'm happy to have a consultation and understand this with you and see if it makes sense for you to consider doing. But the idea is to start to build up that tax-free income for retirement or passing down tax-free assets to the next generation. And so my thought process is it's a fantastic idea, especially when things are changing. Things are changing, meaning your income is down because of a tough year, or things are changing because the stock market's been volatile and crazy. And so those are some reasons you want to consider doing it. So if you have questions, please reach out. I'm happy to answer them. If you enjoy this podcast, please share this with a friend. Keep this thing growing. And I truly appreciate you listening, and have a fantastic day.